Welcome, everyone. Today we're diving deep into the payments industry. I mean, this world is just buzzing, isn't it? So much rapid transformation.
Absolutely. Digitalization is really accelerating, and consumer behaviors, well, they're constantly evolving. It's reshaping everything.
Yeah, how we shop, how we pay, how businesses operate. It's right at the heart of the global economy.
Truly is.
So our mission on this deep dive is, to cut through all that noise. We want to pull out the vital nuggets of knowledge, the things that really define success for these payments companies. Think of it as maybe a shortcut to understanding what makes these huge, really impactful companies tick, how they survive, how they thrive.
Right. And we need to unpack the difference between just raw data points, the metrics, and the strategic insights, your KPIs.
Exactly. The why behind the what.
And that why is so crucial. We're here today to explain not just what these companies should measure, but really why it matters. And how these numbers, well, they empower strategic decisions, they help ensure growth, and give a company that really important competitive edge.
Okay.
So by the end of this, you should have a pretty clear grasp of how payments companies manage their financial health, how they process, trillions of transactions efficiently,
Trillions. Yeah. It's mind-boggling.
build strong customer relationships, and, critically, how they tackle some pretty significant risks. It's about seeing that whole interconnected web of indicators.
The web that drives this massive industry.
Precisely.
And to help us navigate this intricate landscape, we've pulled together insights from, well, a stack of sourced reports and research. Really good stuff.
Yep, we've distilled the key bits.
Tried to make it comprehensive, but also, crystal clear. So let's get into it.
Let's do it.
Okay, let's start unpacking this with our first big topic, core operational performance indicators. These are really the nuts and bolts, right?
Exactly. How a payments company actually works. Day-to-day efficiency, reliability.
And we have to start with transaction processing efficiency. Because in payments, well, speed and success, they're just paramount.
You can't overstate it.
So first up, payment volume. And this isn't just counting payments, is it?
No. It's about gauging growth, understanding the sheer processing capability of a company.
And the scale. I mean, give us a sense of the scale here.
Okay, get this. In 2023, the industry processed something like 3.4 trillion transactions.
Trillion. With a T.
Valued at, wait for it, $1.8 quadrillion.
Wow, okay.
And it's just accelerating. Digital payment volumes hit $18.7 trillion in 2024, projected to go over $33.5 trillion by 2030.
That kind of volume puts incredible pressure on the systems, I imagine.
Immense pressure. They have to perform consistently.
Okay, closely related then is the payment acceptance rate. What does that tell us?
This tells you the proportion of payments that actually go through successfully compared to all the attempts. It's critical because it reveals customer friction points.
Friction points.
Yeah.
Like where things get stuck.
Exactly. And think about this. Failed payments can account for up to 15% of lost e-commerce sales.
15%. That's huge.
Yeah.
Just revenue left on the table because a payment failed.
Gone, simply because it didn't go through.
And then, of course, speed. Payment processing time or latency.
Yeah, speed is everything here. The optimal benchmark is, well, it's lightning fast. Less than 200 milliseconds.
Sub 200 milliseconds. That's incredible.
It is. And when times are longer than that, the user experience just plummets. And the risk of cart abandonment, it shoots way up.
Right. I mean, we've all been there, waiting for that little spinner.
Exactly. And here's an example. Just implementing a simple one-click checkout can cut that processing time by 50% or even more.
50%.
And that potentially boosts conversion rates by up to 30%. Faster is just better for the customer and definitely for the company's bottom line.
Okay, so speed, success, crucial. But every payment has a cost associated with it, right? Yeah. How do companies manage that?
Ah, good point. That brings us to cost per payment. This is a really key financial KPI within the operations side.
Okay.
Because it directly helps companies spot chances to cut costs, maybe negotiate better rates with their providers.
And in an industry with often thin margins, that must be vital.
Absolutely vital. Every fraction of a cent saved there can go straight to profitability.
Makes sense. What else operationally?
Then you've got transaction success rate and authorization rate. For transaction success, you're looking for a really robust benchmark, like 95% or higher.
95% plus.
Yeah. And if authorization rates are low, that can signal deeper problems, maybe invalid card data, or even issues with the bank that issued the card.
So it's a diagnostic tool in a way.
It really is. And what's interesting is how tech steps in, things like payment orchestration platforms.
Orchestration, what's that exactly?
They intelligently route transactions, send them across different payment gateways to find the best path for success.
Optimizing on the fly.
Exactly. And these platforms can actually boost merchant authorization rates by, say, 2% to 3%. That's direct revenue increase.
2 to 3% might not sound huge, but at scale.
At scale, it's significant money. And on the security side, there's the authentication rate. This is key for things like 3D Secure.
Right, that extra security step online.
Mm-hmm. And you have to monitor response times here really carefully. You want security, but not so much friction that customers just give up and leave.
A balancing act.
Always.
Okay, so beyond individual transactions, what about the overall system?
Right. System reliability and the user experience. Super important. Think about system uptime percentage.
Basically, is the system available when needed?
Precisely. And what does that mean for trust? The benchmark you want is 99.9% or higher, often called 3 nines.
3 nines, okay.
A payment gateway with high uptime, it just builds incredible confidence, especially during peak times, like holiday shopping.
Yeah, if your payment system goes down on Black Friday?
Complete disaster. You're not just losing sales in that moment, you're damaging trust long term.
And you mentioned user experience again, response time.
Yep, circling back to that. Still aiming for less than 200 milliseconds. A clunky or slow checkout. It's not just annoying.
No, it directly hits satisfaction, leads to abandoned carts, like you said.
It's the digital version of a queue that's way too long. People just walk away.
And finally, errors.
Yeah, the error rate. Generally, you want this below 1%. But the real power here is in the decline breakdown.
Decline breakdown, so why did it fail?
Exactly. Categorizing failures, was it suspected fraud, insufficient funds? A technical issue. This lets companies pinpoint the actual root causes.
So you move from just knowing that there's a problem to understanding why and then how to fix it.
Precisely. It's actionable insight.
Okay, so if we pull all these operational metrics together, what's the big picture?
Well, what becomes really clear is this direct link, right, between fast processing, high success, and acceptance rates, and revenue.
It all connects back to the money.
Absolutely. It's like a domino effect. Slower times mean abandonment. Higher errors mean lower conversions. It's missed revenue.
So optimizing operations isn't just about being tidy.
No, it's a direct path to boosting that top-line revenue and improving customer satisfaction along the way.
And profitability, too, with the cost per payment aspect.
Definitely. Reducing that cost per payment directly improves your profit margins. In an industry where margins can be tight, that efficiency is a huge competitive advantage.
Right. Okay, that makes a lot of sense for the operational side. Where do we go next?
Let's shift gears a bit and talk about the economic vital signs, the key financial health metrics.
Okay, the money side again, but maybe from a higher level.
Exactly. This is about long-term viability, profitability. Is the company genuinely healthy, not just busy?
Got it. So what are we looking at here?
Well, first is profitability analysis. We look at things like gross versus net profit margin.
Gross being after direct costs, net after everything.
You got it. Gross profit shows what's left after those direct processing costs. Super important in this high volume, often low margin business. Net profit, though, that factors in all the expenses, taxes, interest, overhead. Gives you the full picture.
Okay. What else under profitability?
We also look at operating margin and EBITDA margin. These help you assess how the core business operations are performing. Makes comparisons between companies a bit clearer.
Right, stripping out some of the noise.
And there's a unique one for this industry, the payment cost-to-income ratio. This directly shows how efficiently the payment processes themselves are generating revenue, really highlights that need for lean operations.
Interesting. Okay, profitability. What about just paying the bills?
Yes. Liquidity and solvency. Can the company keep the lights on, meet its obligations?
Short-term and long-term.
Both. There's a whole suite of metrics here. Current ratio, quick ratio, debt to equity, working capital ratio.
Lots of ratios.
Lots of ratios. But generally, a higher number in these usually signals greater stability. Less risk of, running into trouble.
Okay, stability is good. What about using money effectively?
That's capital efficiency and returns. How well is the company actually using its capital, its assets, its equity to make money?
So metrics like ROA and ROE.
Exactly. Return on assets, ROA, and return on equity, ROE. They tell you how much profit the company generates from its assets and from the money shareholders have invested.
And that might look different depending on the company's model, right? Like asset-light tech versus heavy infrastructure.
Precisely. You have to interpret these in context. An asset-light platform might have a very different ROA profile than one heavily invested in, say, physical terminals. We also use return on investment ROI for evaluating specific projects or investments.
Gotcha. Is there one metric here that's particularly telling?
Well, in my view, the really compelling ones are cash flow from operations, CFO, and the related cash flow margin.
Cash flow. Why is that often seen as clearer than net income?
Because CFO focuses purely on the actual cash generated from the core business. Net income can be influenced by accounting rules, non-cash expenses. CFO strips that away.
So it's the real money coming in and out from doing business.
Exactly. And a strong cash flow margin means the company has more tangible cash available.
Available for what?
For reinvestment. Investing in better tech, like advanced fraud prevention, upgrading infrastructure,
Yeah.
expanding into new markets, or even just having a cushion to weather economic downturns without scrambling for external funding.
So it's the lifeblood that fuels growth and resilience.
That's a great way to put it. It really is.
So quick question then. Should a company always prioritize that cash flow, that CFO, over maybe recorded net income? Especially if they're trying to grow really aggressively.
That's a critical question. It's about balance and strategy.
Okay.
You see, aggressive growth may be acquiring lots of new merchants fast, or investing heavily in developing new payment tech that might temporarily push down metrics like ROA and ROE.
Because of the high upfront investment.
Right. Those investments cost money now, but if they lead to significantly higher payment volumes or diversify revenue streams down the line,
Then the returns should eventually improve.
that's the goal. So you have to look at a company's financial health, like ROA and ROE, within the context of where they are in their life cycle, their growth stage, their strategic priorities.
So an early stage company might accept lower returns now for market share later.
Exactly. They might consciously make that trade-off. Whereas a more mature company might be focused more on optimizing the returns from the assets they already have. It's a strategic choice.
Okay, that makes sense. And that idea of growth leads us perfectly into our next section, right? Customer, growth, and revenue metrics.
Yep. Shifting focus now to how these companies actually grow and capture value. Market penetration, customer relationships, all that good stuff.
And the foundation of that growth has to be customer acquisition and retention, I assume.
Absolutely fundamental. Here we talk about two really important metrics: customer lifetime value, CLTV or LTV.
Which is the total worth a customer brings over time.
Exactly. The total economic value you expect from that entire relationship versus the customer acquisition cost.
How much it costs to get that customer in the door.
Oh, precisely. All the sales and marketing spend divided by the number of new customers acquired.
Okay, so LTV and CAC, how do they work together?
You put them together in the CLTV-SAC ratio. This is a crucial indicator. It tells you about overall profitability and how effective your whole acquisition engine is.
Right. Is there a benchmark for this?
Yeah, for businesses that look a bit like SaaS, which many payments companies do, with recurring revenue, a healthy ratio is generally considered to be around 3.1.
3 to 1. LTV 3 times the cost to acquire.
Correct. If it's much higher than 3.1, say 5.1 or more, you might actually be under-investing in growth. You could potentially grow faster.
Interesting. Leaving opportunity on the table.
Could be. If it's below 1.1, well, that's clearly unsustainable. You're spending more to get a customer than they're worth.
Not a good place to be.
Definitely not. And that zone between 1.1 and 3.1, it might be okay in the very early stages when you're just starting, but it signals you need to optimize things pretty quickly.
Got it. What about keeping customers? Churn.
Churn rate. Hugely important. Both customer churn, losing customers, and revenue churn, losing revenue even if the customer stays but spends less.
Why track both?
Because they tell you different things. Are you losing lots of small customers or a few really big ones? It helps you understand the source of the attrition. And even a seemingly small churn rate, like say 5% annually, that can seriously erode your recurring revenue base over time.
Yeah, that compounding effect.
Yeah.
Okay, so acquiring and keeping customers, what about the money they bring in? Revenue generation and monetization.
Right. Here we look at things like monthly recurring revenue, MRR, and annual recurring revenue, ARR, that predictable income stream. It's the backbone.
The predictable part is key for planning, I guess.
Absolutely. Then there's average revenue per user, ARPU, or sometimes average order value, AOV.
Yeah.
Basically, how much value are you getting from each user or each transaction?
And a higher ARPU is better.
Generally, yes. It means you need fewer customers to hit your MR goals. It can also sometimes indicate if maybe your product is underpriced. Are you leaving money on the table with each customer?
Interesting angle. What else in revenue?
We also track conversion rates very closely. These immediately flag friction points in the sales or payment process.
Like we discussed with payment methods.
Exactly. We heard that stat up to 17% of shoppers abandon carts if their preferred payment method isn't there. And localizing payment methods, offering what people in specific markets expect, can boost conversion by an average of 12% in new markets.
Wow. Little things make a big difference.
They really do. We also look at net revenue retention, NRR. This measures revenue from existing customers, including upsells and expansion minus churn and downgrades. It's a great signal of product market fit and how well you're growing within your customer base.
So are customers sticking around and spending more?
That's the essence of it. And finally, things like revenue concentration. Are you too reliant on a few big clients? And sales growth rate. How quickly are you closing new business?
Okay, lots to track there. How does this all connect back to that LTV CAC idea?
Well, the LTV-TAC ratio really shows the symbiotic relationship, right, between creating customer value and achieving sustainable growth.
Symbiotic. How so?
A healthy ratio means you're generating enough profit from customers to reinvest back into sales and marketing, which fuels more customer acquisition, which hopefully maintains a healthy ratio. It's a virtuous cycle.
If you get it right.
If you get it right. And optimizing that ratio isn't just about getting more customers, it's about getting and keeping the right valuable customers. That might mean targeting specific high-value segments or tweaking your pricing models.
Right. And speaking of revenue models,
Yeah.
how do these companies actually make money? It's not just transaction fees, is it?
No, not at all. Transaction fees are usually the primary source, yes, but there's more. A big one is interchange fees.
Interchange. What are those exactly?
These are fees collected by the banks that issue the credit or debit cards during a transaction. The payment company often facilitates this, but the fee itself goes to the issuing bank.
And do they vary much?
Oh, hugely. Based on card type, like premium versus standard, transaction method, in-person versus online, the merchant's business category, transaction size, even the region. It's complex.
And they're a cost for the merchant, right?
A significant cost. They make up a big chunk of operating costs for businesses accepting cards. So they're a major factor in the payment company's overall cost structure and pricing.
Okay. Transaction fees, interchange. What else? This is where it gets interesting, you said.
Yes. Value-added services, VAS. This is where companies really differentiate and innovate beyond just moving money.
Like what kind of services?
Think specialized fraud prevention tools. Stripe Radar is a good example. Advanced analytics platforms like Stripe Sigma that give businesses deep dives into their payment data.
So helping businesses understand their own payments better.
Exactly. Or comprehensive billing and subscription management like Stripe Billing makes recurring payments much easier for businesses. Then you have broader platform services. Stripe Connect, for instance, lets other platforms like marketplaces or SaaS companies not only collect fees easily, but also offer integrated financial solutions to their own users.
Like embedding payments into their own software.
Yes, and more. Things like in-person payment terminals, automating sales tax calculations. Stripe Tax does this on a usage-based model, offering business financing, even letting platforms issue their own custom cards.
Wow, that's way beyond just processing a payment.
It really is.
Yeah.
This is where a lot of the growth and, frankly, the higher margins often are.
So strategically then, why is this diversification into VAS so important? Is it just about adding new things to sell?
It's much more strategic than that. It's a crucial hedge, a protection against market volatility, and, importantly, potential fee compression.
Fee compression, like transaction fees getting squeezed lower.
Exactly. The core payments market is super competitive. There's always pressure on those basic transaction fees. Plus, you have regulatory actions like the interchange fee caps we've seen in places like the EU and India.
Right, regulations can change the game overnight.
They can. So if a company relies too heavily on just those basic transaction fees, they're vulnerable. Diversifying into VAS creates new revenue streams, obviously.
But more than that.
Much more. It strengthens the customer relationship, makes the platform stickier, harder for a customer to leave because they rely on these integrated services, and it builds a much more stable, predictable revenue base overall. It insulates the business from those fluctuations in core transaction fees.
So it builds a more resilient business model overall.
That's the key. Resilience.
Okay, resilience is crucial. Which brings us neatly to risk, doesn't it?
Absolutely. Let's talk risk management and fraud prevention KPIs. This is absolutely critical. We're talking financial integrity, reputation. It's a constant battle.
A battle against fraud, mostly.
Fraud is a huge part of it. Under fraud performance, we monitor the fraud detection rate. How good are the systems at catching actual fraud? But crucially, without blocking too many legitimate transactions.
That balancing act again.
Always. Then there's the payment fraud ratio, or fraud rate. The goal here is usually less than 1%.
Less than 1%. How big is the fraud problem overall?
It's staggering. Global payments fraud losses hit $38 billion in 2023.
Billion. Right.
And projections suggest cumulative losses could top $400 billion over the next decade.
400 billion.
And a huge chunk of that, over 80% of all card fraud worldwide, is card not present. CNP fraud. Online, phone transactions where the physical card isn't used.
That makes sense. Harder to verify.
Much harder, which highlights that delicate balance again. We also track the false positive rate.
Blocking good transactions by mistake.
Exactly. Mistakenly declining legitimate payments because your fraud system was too aggressive. That means lost revenue, obviously. But it also creates huge customer friction. People get annoyed. They might go elsewhere. They might churn.
Yeah, having your card declined when you know it's fine is incredibly frustrating.
It really is. So you have to measure the precision and recall of your fraud systems. How accurate are they and how much fraud are they actually catching versus letting slip through or blocking good customers?
Okay, fraud is one big risk. What about chargebacks?
Right. Chargeback management, also vital for financial stability and reputation. The main metric is the chargeback ratio, or rate.
How is that calculated?
It's the number of chargebacks divided by the total number of transactions, usually over a month. An acceptable rate is generally pretty low. 0.5% or lower is often the target.
0.5%? Are there official limits?
Oh, yes. The card networks like Visa and MasterCard have strict thresholds. Visa's is currently around 0.9%, MasterCard's around 1%.
And what happens if a merchant goes over those?
Severe consequences. They can face hefty fines, much higher processing fees, and in worse cases, the network can just terminate their account. They can lose the ability to accept those cards altogether.
Serious stuff. What's a typical rate?
Well, the average for e-commerce in 2023 was already hovering between 0.6% and 0.9%. So merchants are often operating quite close to those thresholds. It's a constant challenge.
And chargebacks aren't just the lost sale, right? There are other costs.
Definitely. There's the cost of dispute resolution, the time and effort spent fighting the chargeback, plus potential penalties. These hidden costs can eat up, believe it or not, 5% to 15% of an e-commerce merchant's operating expenses.
5 to 15% just dealing with chargebacks? That's enormous.
It adds up incredibly quickly. It's not just the lost revenue, it's a significant operational burden.
It really does sound like a constant tightrope walk. Trying to stop fraud, manage chargebacks, but without blocking good customers or making the process too painful.
That sums it up perfectly. You have to optimize fraud prevention to maximize legitimate approvals while minimizing actual fraud losses and chargebacks. They're interesting because they're a multifaceted indicator.
How so? Not just fraud.
Not always. Yes, they can signal fraud, but they can also point to other operational issues, maybe unclear billing descriptions on statements leading to confusion, or poor customer service that makes customers resort to a chargeback instead of seeking a refund directly.
So it can be a sign of other problems in the business.
Exactly. So proactive management is essential. Mitigating financial penalties, staying compliant with network rules, safeguarding that hard-earned reputation. It all ties back to ensuring a smooth, trusted customer experience that encourages repeat business, even while you're fighting increasingly sophisticated fraud attempts.
Okay, so we've covered operations, financials, customers, risk. Quite a landscape. How do the smart companies pull all of this together? It feels like it has to be about continuous optimization, right? Staying ahead.
That's exactly it. Which brings us to the final piece, strategic implications and continuous optimization.
How do you make sense of all these different numbers?
Well, first, it's about integrating KPIs for holistic performance assessment. You can't look at any single KPI in a vacuum. It just doesn't tell the whole story.
Right, they all connect.
They do. A truly holistic approach integrates the operational, the financial, the customer, and the risk metrics. You build a comprehensive picture. We often see KPIs categorized for, say, the C-suite into maybe must-haves.
Like authorization rate, conversion, fraud.
Exactly, those core ones, then maybe advanced metrics and even emergent ones, perhaps tracking performance related to new regulations like PSD2 or strong customer authentication in Europe. It's understanding that interconnected impact.
Okay, see the whole picture. What else?
Leveraging benchmarks for competitive advantage. You have to know how you stack up against the industry.
Compare yourself to the average.
Or to best in class, ideally. Benchmarking is crucial for spotting areas where you're lagging or maybe where you're excelling and could press that advantage. We mentioned CyberSource providing data for hotels. That kind of insight is invaluable.
But it's not just about seeing the number, right?
No, the key is understanding why discrepancies exist. If your authorization rate is lower than the benchmark, why is that? Is it your fraud rules, your data quality, your routing? The benchmark is like a strategic compass, not just a scorecard. It tells you where to dig deeper.
Dig deeper with data.
Yeah.
Which leads to the next point.
Exactly. The role of data analytics in driving payment strategy. One source put it perfectly. Attempting to evaluate a payment processing system without robust data is akin to navigating without a compass.
Love that. Especially in this market.
Especially now. The environment is just incredibly dynamic. We talked about surging digital volumes heading towards $33.5 trillion, rapid adoption of digital wallets, instant payments, cross-border e-commerce booming.
Constant change.
Constant. And that demands real-time granular data. You need to be able to spot emerging opportunities or mitigate new threats almost instantly.
Like seeing decline rates spike for a specific bank issuer, or fraud suddenly increasing through a particular channel.
Precisely those kinds of things. That level of agility powered by data lets you optimize your payment routing on the fly, adapt quickly to new payment methods customers start demanding, and just generally respond proactively to shifts in the market rather than getting caught flat-footed.
So that agility, driven by the data and analytics,
Yeah,
that's the key to continuous improvement.
it really is. That's what ensures continuous optimization. Benchmarking tells you where you stand and maybe where to look, but the deep data analytics tells you why and helps you figure out what to do about it.
Right, so it transforms data from just numbers into actual strategy.
Exactly. It helps you find the blind spots, drive targeted improvements in your tech, your fraud rules, your customer experience, and ultimately secure that significant competitive advantage.
Okay, so let's try and wrap this up. To recap then, success in this incredible complex, fast-moving payments world. It really hinges on meticulously tracking, but more importantly, integrating all these different metrics: operational, financial, customer, risk.
Couldn't say it better. You have to see the whole picture.
And it's this integrated view that gives companies the critical intelligence they need, right?
Yes. For agile decision making, it fosters that continuous optimization we talked about, and it secures a sustainable competitive edge. It's all about proactively adapting, spotting trends, unlocking new opportunities, not just reacting.
Makes perfect sense. So as we finish this deep dive, maybe a final thought for everyone listening.
Go for it.
Consider just how deeply payments are woven into our everyday lives. We barely think about them sometimes. But if optimizing all these intricate metrics can unlock so much value for the companies handling trillions of dollars, what untapped potential might lie in understanding the performance indicators of your own financial life?
A good one.
Something to ponder.